This conference will now be recorded.
Good evening, ladies and gentlemen. This is Cluelessly Trading Frank. It's approximately 8:31 p.m. Pretty much on time today, so that's good news. 8:31 p.m. on November 1st, 2020. 48 hours to one of the greatest and most critical elections coming up on Tuesday, November 3rd. So unless you voted, don't forget to vote and exercise your rights. And let's move on. Full disclosure, this is purely for financial education, not for any solicitation or advice. This is our standard weekend Sunday webinar where we go through a few things and try to predict as much to our ability, to my ability to figure out, what's going on and what might happen going forward. On that note, welcome. These sessions are recorded and directly uploaded within 20-25 minutes after we end on the real-time Twitter feed. So click that link for GoToMeeting and listen to it at your own time. And then it gets uploaded to the YouTube channel, hopefully tonight, if not by tomorrow morning. So that's just so you all know. Okay. So first of all, I don't need to remind anyone that we are going through probably one of the most volatile periods in the market since September. We're going to go through a few charts. We're going to start off with the longer term charts because that's going to give us a perspective on, what's going on, where we might fall to. There's a lot of uncertainty in front of us. I don't need to remind anyone. And there could be, there are great opportunities in between. And at the same time, it might not be as bad as we all think. Let's just put it that way. So, again, it was exhausting week, had a couple of fast movers, but hey boy, that market was it was just too fast, too quick. I know we had a couple of spy puts. I wish I had a lot more, but it's very difficult just for all of you to understand. And of course, you guys place your own decision on what you need to do. My charts and stuff are just tools for you to use, and then you look at it and you use your own discretion to do what you need to do. Is what's difficult is, and we're going to look through some metrics tonight, is when things get this critically deeply oversold on a technical level, it gets very difficult to put out a swing short, let's say, and just say, okay, that's definitively going to make money. Because people who did that, for example, other market players, and I'm sure some people within our Cluelessly trading community, let's say at the bottom of the market on Friday, I believe we were down at one point, lose track, almost 500 points, 486 points, and we ended not up, but from the bottom up, we ended down 156 points on the Dow, looking at the broader indices. So the key is that what's been working, what the part that's working for me is when I'm doing these SPY puts, for example, the ones that I told people to buy middle of last week or so, which were the November 2, 330, 320 calls. November 2nd, 320 calls. November 2nd meaning tomorrow. I didn't want to go out too long on those puts. Those things intraday worked out quite well. We're never going to catch, I mean, I'm sure some people can, but I don't catch exact top or exact bottom. But net, you get the meat in the middle, and that's that's a-okay. I also did put out there very clearly that given the extreme oversold readings on the New York Stock Exchange oscillator, the NYMO, which we're going to look at again tonight, which was at minus 81, 82 on Wednesday, that we would get a quick, fast rally within 24 to 48 hours, which we did, and that would be sold. And that's exactly what happened. If just to backtrack, and that's on my real-time feed. And of course, I didn't get a chance to do the Wednesday webinar. But I did mention that clearly on my real-time feed. If you scroll down, you'll see. And so that worked out quite well. And I know some great members and traders like Paul here managed to benefit from that type of very prescient and predictive call. Okay. On that note, let's dive in directly. And before I go any further, let's put it this way. At this point, the markets are so super choppy, so super extreme absolutely volatile that making a short-term prediction, whether you're using the Fibonacci retracements, whether you're using many other things that I use, tools that I use, which have worked very well over the years, is almost meaningless, because things, I notice the movement, the algorithmic high frequency trading black box movements on individual stocks, for example, during the day. And it's mind-boggling. I mean, it is just within seconds, up 15, down 30, up 10. So unless you're an active trader, best not to trade, to be honest with you. Part of trading is not to trade certain days. I know it's hard for me to do because I'm a trading junkie, and I'd like to attack the market at all given times. But a couple of things that have helped me on keeping the losses on certain days to a more normalized level, so your brain doesn't get fully shot for the next day's work, is smaller positions and taking profits faster. No question about it. And if I'm doing some active trading on the day trading side, I'm certainly taking profits very quickly. I am also getting out of positions with a 30-40% loss if needed to be. So biggest thing that has really helped me is reduced position size. So instead of having 10 contracts, I'll have 1 or 2. And if they go, they go. On the cheap calls, yeah, I have a bunch of them. If I have 40 or 50, for example, on the real cheap ones, then just giving you a hypothetical example, then I'll reduce it down to a lower number. So this way, what it does as tactical traders, it reduces the P&L volatility, which can be extremely detrimental to somebody's mental confidence for no fault of their own, because the markets are so extremely volatile, literally minute by minute. Okay, so when you see that P&L going up and down a couple of hundred points, couple of thousand, couple of $100, couple of $1,000, depending on the size of your trading portfolio, it's it's difficult. Let's face facts. Emotions are no emotions. Now, if you don't want to look at that and you just say, okay, this is where I think the markets will after the short-term volatility passes, which I believe the markets will stabilize and attempt to move higher as the volatility stabilizes, then that's a different story. All right, so just passing on a few simple things which work. So on that note, let's dive into the charts. I'm going to start off with the daily on the candlestick investing.com platform. And this is what we're looking at here.
Quick question.
Yes, of course, Chris.
That when SPY hit that level, it was what was it? 322, 323.
Okay, let me pull up the SPY chart for you. It's right here, so we can follow what you're saying. 1 second, sir. So if I'm looking at the SPYs here, let me zoom in a little bit on the shorter term side. Actually, that doesn't really give us a real good look. But let's stick to the daily chart here. Yeah, go ahead. So
yeah, it's fine. When that on Friday, when that hit that level, I mean, what is so special about the 323 level? It just rocketed up in the last 15 minutes of trading.
15 minutes to half an hour of trading.
Yeah, actually, it was like the last five minutes. It seemed like it just painted these massive green candles right up to like 327.
Yes. Correct, and those are automated programs which are designed to buy pretty much at this level. I mean, if somebody wanted to be very if somebody wanted to go like literally point by point, it doesn't always hit that exact number. Then we should have been looking at around 319.76 right there. You see that? See this line here? Because that was the bottom that the market printed on the SPYs, SPY, on the 24th of September, as you can see the date below, right there. Okay, right there. And it also did the same thing on the 21st of September. It almost went there on the 23rd, the 24th. So that's a major support level, and that's this line that I've shown on my charts. Excuse me. And that's the simplest reason why the short covering programs went into effect. And it wasn't necessarily new buyers, just so you know, Chris. It was basically just the automated short programs that are run by the hedge funds and the institutional funds players. basically the quant funds, as we call it. So they automatically went into overdrive, just covering their shorts, and that's the reason why that happened. It's this candle here, what we're talking about. So if you look at it, it was still red, but if we zoom in, like you're saying correctly, it was within the last. This was Friday. And it was this what you're talking about. It actually started off at around 135, right there at 135. Sorry, 335. My apologies. It initially started off at 245, then came down and retested almost the same level at 335, and then some big shortcut. These candles that you're looking at, which are primarily very large, very fast moving short covering programs, and the volume exploded right there. So it just literally exploded. You can see that. I mean, that was the highest buy vol green bars. That's purely because of short covering.
Hey, Frank?
Yeah, go ahead.
Okay.
I just like to get your opinion on kind of a way of thinking I'm looking at. We all know, and you've discussed it many times.
Just
Yep.
bear with me 1 second.
Yep.
Chris, did you have a follow-up question to that? Because that was a very good point that you brought up, so other people can also see, what I just showed.
Well, yeah, I was expecting this to go down and hit, basically at least match that low, that September low in 318.
To be exact, it was 319. 1 second, sir. It was right here. 319.55. Now,
Yeah.
one of the things, Paul, I'm going to come back to you in 2 minutes. One of the things that I've seen happen, and we are, after all students of the market, right, is that when everybody's looking at that exact spot, they will start to do it a little bit earlier. Do you understand what I'm saying? So that's exactly what happened. So everybody's looking at that 319.55 level right there. And they started to do it at the short covering started at 322.56. So I've seen this happen quite often. It doesn't always get there. It starts a little bit earlier, not to the exact dot. So that's the answer to that question, and this I've seen happen a lot.
Okay, got it. Thank you, Frank.
Yeah, not a problem, sir. Paul, go ahead with your question.
Thanks, Frank. Yeah, so I was just wondering your thoughts on this idea. So we know, and we've discussed on your webinar many times, there's about $5 trillion on the sidelines that was pulled out since March, and really none of that money really came back, and if anything, probably some more on top of that came out. Does that give us a bit of a cushion? Because with Christo's question there too, with the Friday, I got the sense too that there was a lot of people taking advantage of easy short money, and they were probably covering at the end of the day. Do you get the sense though that there's like there's not real longs that are selling? It's more the short sellers, and maybe our downside is limited because all the cash is already taken out. It's a record number of cash that was taken out.
So let me answer this question. It's such a fantastic question based on the same question you had asked me about 2 weeks ago or so. And my answer, if you guys remember correctly, was that no, I don't think. Remember, it was like a month ago or 3 weeks ago, you asked me the question, do you think the $5 trillion might, some of it might be starting to come in? And my answer is, I said, no, I don't think so, because of the uncertainty that's looming in November. So I'm going to answer this question this way. This time I actually agree with you. And why do I agree with you? Well, I agree with you that part of that 5 trillion at this point is going to start to siphon back into the market, not just because we have had 9, 10, 11% corrections on overall indices on an intraday basis, or just over the past, this was one of the, since just October 12th, 3 weeks ago, but also because this time, with the elections getting over, I believe there is going to be a level of certainty where, regardless of whoever wins, they are going to say, you know what, at least we know what we're dealing with. And I think this time round, part of that 5 trillion in certain sectors, and I'm sure it's going to be also, a lot of that trillions that came out of the what do you call, the tech sector, and the solid companies, which are growing at 30, 40, 50% a year, despite all the COVID-19 and the global uncertainty and all that stuff. I believe a lot of that is going to go straight into that, and of course go into some value companies, go into some retail companies, go into the airlines, and things like that, because after all, they will have some level of certainty, and hopefully the COVID-19 situation starts to, dampen down a bit, and the airlines have all started their antigen and COVID-19 immediate tests right there at the terminals. So hey, you get in there, you're fine. Like I said, it'll happen. So yes, in answer to your question, Paul, I do think that that money at this point, some of that money will start to filter in if we don't start to see a spiraling down of any political ramifications after the election, which is still a little bit of an unknown. And if some larger, and remember, we have a whole bunch of earnings to still come out over the next couple of weeks. So if some of them don't go are not that extremely downbeat on the forward guidance, yes, I do believe that money will start to come in, and that's going to be a huge boost to the markets. And if you look at it from a technical standpoint, basically we are at this point, and it obviously takes a couple of days for us to see that. Let me just change the color right there. We have a definitive double top here, right there. We were analyzing this. It was looking like a nice consolidation channel till it broke below the 50. Now we are considerably lower below the 50-day moving average. I would say the standard deviation right now is probably about -3 or so. And it's exactly the same that had happened back in September. So if you want to look at this pattern symmetry here, at this point we had a nice inverse head and shoulder, which hit almost, again, not exactly, but almost towards the all-time high. It was almost getting there. And now that we broke down, this pattern here, the zigzag down in two tranches, is exactly the same as what is happening now. Now, one of the other interesting things that happened tonight is when you looked at, I know we had a time change, when you looked at the Globex futures when they opened at 6 p.m., we were down about 20 or 30 handles on the S&P 500. The S&P 500 has now turned around and up 7 handles, which is fantastic. That's almost a 27 to 30 points higher from the lows just within the past 2.5 hours, 3 hours. We have the NASDAQ up about 24.5 points, the NASDAQ futures and Qs, and we have the Dow Jones Industrial Average up about 46 points. So saying all that, if I'm just focusing on a very simplistic basis, and these things, keeping it simple at this stage is actually the best policy, in my opinion. That's what's worked for me over the years, is this is the pattern we're looking at. Now, here is that major line that if the market does cross, there is going to be another fast selling, and it probably is going to be an intraday move where if we do break below that 320 level or 319.77, let's call it 320, we're going to see a fast move down to retest this rising 150-day moving average, which most of the media doesn't cover or anything, but this is looked on and played upon by hedge funds, and believe it or not, it's still rising, believe it or not. And the first thing you're going to hear is a retest of the 200-day moving average. This is still a possibility. So let's keep that in mind here, okay, because of the uncertainty going ahead with elections. Hopefully it'll be a smooth transition and everything's going to be fine. But the 200-day moving average down here is 312 on the SPYs. So you're looking at about 3,100, 3,120 on the S&P 500. And that is still a possibility. Okay, let me go back to the SPX, because that's is a more not reliable. SPY is too, but if we look at this, it's very clear cut and dry. We have a definitive neckline right here. Here's your double top. Okay, here's your neckline. So and these are head and shoulders too. It's a double head and shoulder. So basically, this neckline is 3194. The very simple numbers, and these are the numbers that the machines are following. If this 3194 is not held, then obviously we are going to see a sharp move down, and that's going to attack the 3166 level, which is the rising 50-day moving average. I'm sorry, 150-day moving average, and then we are going to. And then the 200-day moving average comes into play at around, what is that, 31. Let's call it 3130. So these lines are, believe it or not, still in play. And but again, all depends what's going to happen over the next 48 to 72 hours, to be honest with you, and possibly a couple of days more. Now, looking at the short-term pick, I mean, looking at the internals to see, this is just like here that happened back on September 1st, and this started on October 12th. Very, very fast multi-day pullbacks. Some attempts to recover, but then getting slammed. We are there. I mean, we are definitively in extreme oversold levels, no question about it. However, keep in mind that just the way when markets are rising, they can stay overbought, over 80, or on the STOs, on the RSI, for example, can stay over 80, shows the strength of the market as it keeps on climbing. The same thing can occur on the downside. They can stay below the 20 mark for a couple of days. They don't necessarily need to come down and immediately turn around. So the key is that we have to keep that in mind. And that this had happened back here where we stayed below the 20 STO, in this case, the full stochastics, which is the first derivative of the relative strength index. We stayed below that as the market slid, had big rallies, slid, big rally, slid, but then it started to bottom, and this took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 3 trading weeks, almost 3 trading weeks. And guess what happened? It stayed below 20. Now, will that happen this time? I don't know. We shall see. There's a bunch of metrics that I look at, bunch of indicators that I look at. The dailies are looking quite oversold. So a short-term bounce is very, very possible, but the weekly, and we'll see that on the McClellan oscillator, on the weekly, it's still showing down, which means still a little bit more selling to come before we have a real definitive bottom. Now here, if we look at it, this is bottoming. McClellan oscillator is kind of like, hanging in there, and the MACD is still pointing lower. It's following the same trajectory as the full stochastics. So that's what I'm getting at. That the downside targets are still there. And I wouldn't be surprised if things get a bit too messy over the next week or so, that we come down, and very quickly, I'm talking within 24 to 48 hours, test the 200-day moving average, which will definitively, in my opinion, like it did back in June and in the month of June, twice in the month of June, create a sizable tradable bottom, which will trigger a multi-day, multi-week rally. Just want to be clear on that. Okay, I'm being very neutral at this juncture here because of the technical damage that has happened in the market. So looking at the 3-week chart here, I'm sorry, not 3 weeks. This is the weekly chart. This is what the weekly chart looks like. And one must, at this point, look at these things. There's no question about it. What happens in one single day, whether it's a short covering rally at the end of the day and such, honestly means nothing for the next day. And we have seen that happen repeatedly in the past week to 2 weeks. I think all of you would agree with that. This candle is one big one. There's no question about it. So if you want to look at it from a bearish standpoint or a cautious standpoint, you would say, man, this could expand like this. In that case, those lines that I talked about, the 3100 level, the 3200 is just something we retest, like, we can retest tomorrow, for whatever reason. So that's not the real levels. The real level is the 50-week moving average, which is 3136. The 3100 level, basically the 3100 level. So which means that we would fall another 170 points, 170 times, just to give you guys an idea, times taking the higher factorial, that's another 1360 Dow points. Is that possible? It certainly is. That's the reason. One of the things that I plan to do is not necessarily, and this the people can just do whatever they need to do, is not necessarily have large amounts of money put out thinking that, okay, next week is going to be a better week. So I'm going to keep my trades very close to the vest. I'll be a little bit more active in the daytime, taking scalp profits and such. After all, we all going to make money, and that's going to be my strategy, at least for the short term going forward, because these ones, if you look at it, it is it's again, I'm not a fear monger. You know, I'm overall bullish on the markets. I'm just saying the short-term picture is something that we have to be very cognizant about. Now, if you look at it here, if we look at it here, let's look at the stochastics. If you look at the stochastics, it doesn't look good. I'm not saying it has to go all the way down to the March levels, which is a kind of a generational buying opportunity, and you can get real rich real fast by buying these type of bottoms. But we would need on the daily, on the weekly, this baby to start turning, obviously. And the only way that it's going to do that, because this is a weekly chart, technical chart, the only way it's going to do that if we have multiple days of positive gains on the daily. That's going to turn the weekly charts on the other direction. I just want to be clear on that. So this certainly does not look good on the weekly. Okay, it's a definitive crossover down, and one has to be again cognizant and alert about this matter. The McClellan oscillator is really moving sideways. It's not doing anything, but this one is also something that one has to keep an eye on. We do have the first crossover that started on the 26th of October on the MACD. Now these are very simple indicators, but they're very effective if you track them. So, and we have the first red histogram that went in, and that was last week. Obviously, look at the size of this candle. It went red. Now, will it expand down, or will it simply kind of be shallow and then turn green again? Well, obviously, I'd like it to be shallow and turn green again in order to hold some longer positions and you know, want the and hope the markets go higher. But this is definitively on a weekly basis something one has to watch out for. On the daily, I've already gone through it, so I don't want to hammer it down too much. As we can clearly see, let me get this out, erase all drawings. We are in that short-term deep oversold zone in the -25 on the MACD. It's the same thing that happened before we turned hard on the 24th of September. So this is actually pretty good. It might slip and slide a little bit more, or maybe it just turns from here. McClellan oscillator is fine. And of course, I explained that this is a deep oversold level, and we could see a turn like this. And even a turn like this is a couple of 100 points. Things are moving so fast. And if you notice, we can open down 600, 700, 800 points, or during the day, go down 800 points and then be up, and then not necessarily up, but be only down 150 points by the end of the day. That itself, on an intraday basis, is great money-making opportunity. Whether you play the indices, whether you play the Qs or the SPYs, primarily those are the ones we're looking at, or even the IWM or the DIA. So intraday, when you get that type of fluctuation, I would suggest to tactical traders to take advantage of that, because those things normally would take a couple of days. Now it's happening within a couple of hours, almost every day. So saying all that, the broader picture in the global economy is pretty okay. Yeah, England is shutting down a bit, but they're not going through the severe lockdown restrictions that they did back in March. They have selective shutdown. You know, they're talking about certain parts of the U.S. You know, they'll have selective lockdown. It's not going to be the dramatic, like that's it, everything's shut down kind of thing. And the markets, like they say, they took the first blow in March, so now they can kind of deal with it. They can deal with it. Let's take a look at the same daily chart on the E-minis. And you can see here, this is actually quite constructive. It's the same daily chart, but this is the more dynamic 24/7 Globex E-mini futures. And you can see here that this is where we are. Now, here's the best part of the news, just purely from a technical standpoint. When you move this far so quick away from the 50-day moving average, like I always try to use the simple analogy, when you veer that much away from the standard highway, because these are the highways that the markets would normally follow, then you always have a mean reversion play. In other words, you revert back to the mean. What is the mean in this case? It's the 50-day moving average. So every single time we have broken sharply below, and the most recent being in September, only a month and a half ago, or something like that. Yeah, You always, one way or the other, get back towards the 50-day moving average. Now, whether are we going to break above that, that's a different story. But that mean reversion play itself is extremely profitable for traders. So that's what I'm getting at. Can we slip and slide a little bit and hit that 31.96? We got down to 32.24, and as Chris pointed out, we never got to that 31.99 or 3200 level. Well, it happens. You know, it doesn't always have to get there. Maybe we get there. I'm not sure. But what I'm getting at is that we are starting to see a definitive pattern here coming into play that is going to be quite profitable for traders. Defined head and shoulder, inverse head and shoulder, sorry. This was looking like a cup. It was holding, it was trying to break out. I even drew a chart saying projected that maybe this would happen, but nope, it went bang, bang, bang. All right. So basically at this point, if you want to look at it this way, we are starting to form a nice W formation. Now, will the W formation blast through over the 50-day moving average? I have no idea. But I'll be watching it, and I'll be not just watching it, I'll be trading it. So at this point, we are starting to see a nice W dragon bullish formation if we can break above these parameters that are drawn here. And the first level of direct contact where there's going to be a flurry of selling is going to be at or around the 50-day moving average, which is right here. Okay. Now, the second thing, now, like I always, tell my traders and my advanced coaching students and all that stuff, to look at things in a very simple way, and believe me, they work. And I've said this before, if this starts to cross over up your stochastic, your full stochastics, right there, if it keeps on going higher, despite intraday volatility, you're assured to make money based on past performance. This has been back tested for years. Based on past performance, as long as the trajectory is higher, despite intraday volatility, you'd be a tactical dip buyer on intraday pullbacks. And I don't know if it's going to do that, but I do see a crossover starting to take place. Is it possible that it becomes, for the next 3 weeks, as if there is an election mess and as things are sorted out, that it keeps on, kind of sliding at the bottom and creating, double, triple bottoms? Yes, it certainly can. That's why I'm saying get prepared for massive volatility for the next, depending on what the election outcome is and what happens after that. That's something which is a great unknown and no one can tell you. Okay? So this is very key. If you start to see this convincingly turn, and I have the lines drawn and stuff, you don't have to know the parameters and numbers, you just look at it. And if they start to do that, then you want to be staying long. If it starts to do the zigzag snake dance right at that bottom, then you want to be more short-term orientated and take profits during the day, not hold too many things overnight, things like that. Just simple trading strategy, and it works. Let me just clear this out. Let's take a look at what is happening on this front. On this front, again, we are in a bottoming process. But you don't necessarily need to see this like completely turn around, because by the time the percentage K and the percentage D lines start to have a crossover, it is generally after a few days. Look at that. This crossover happened, look at the date below, on September 30th, but the market actually bottomed on September 24th. And you had 3 big, huge, multiple 400, 500, 600 point type of days. And then the crossover happened. So for people who are a little bit more aggressive, as options traders, we're certainly on the aggressive end of the game, then you want to be a buyer during this level where it's just starting to turn, before the turn is actually seen. Maybe it's tomorrow, I'm not sure. And then you can play it up on that mean reversion trade that we're talking about. So let's take a look at the VIX. Now this same S&P, I'm seeing it in very clear format on those were E-minis here. I'm bringing it in, hold on. On my quad platform, QUODD, very easy on the eye and these charts were drawn months ago. All I do is adjust them. They're kind of forward-looking roadmaps. You can see here very clearly the S stock, which is a slow stochastics, in the same process. Hasn't turned yet, but there, a definitive neckline at 3203, if you want to be very exact. The yellow line as of Friday is the pivot line. Obviously, above pivot is good. And guess what the markets did? It closed at pretty much at the pivot. Look at that. See? And that's why I call this the algo HFT charts, because they're just so precise with the moves. See, it tried to break up over the pivot, but it didn't. We have a very sharply sloping yellow line here. That's the 5-day moving average, right? Same thing here. Very, very similar. We would like the 5-day moving average to turn, but it cannot turn on its own unless we have back-to-back 200, 300, 400 point type of days, or one single day where the market's up 800 points or 600 points. Then the 5-day moving average will be pushed up, which would be fantastic. You can clearly see here, as I showed you on the other charts on the S&P 500, right there, that this is your 50-day moving average, which is roughly around 3,400. So there's a nice mean reversion trade to be had, just the way it happened here. And we can certainly see the two big peaks, the two hills, and those are the, double tops. And I'm not even looking that far. I'm looking at this point, I am looking to see how fast internals are going to turn. This is the fast stochastics. And I want to see, I'm literally going to take one day at a time. And that includes the news flow that's coming out, from the political front. We have a Fed meeting coming up, so there's quite a few things. And of course, we'll be doing some selective earnings plays. So that's pretty much it. We have a big gap here. It's a very similar pattern to this. The danger is that this neckline, if this neckline breaks convincingly, then there's quite a bit of downside here. But it's not going to be a one-way straight line. Generally, market, just for all of you who, well, some of you have been in the market, better than me, but a lot of the newer people who have been with us over the last couple of months, really like really learning like what crazy this business is, and learning there's a method to the madness. As I was just say on Wall Street, to my clients, there's a method to the madness. When you focus on the method, you're going to be not okay, but you're going to be stable and you're going to make money quite a few times. But if you focus on the madness, you're just going to go mad. And that's really what's happening with the hysterical emotional standpoint in the market. They're focusing on the madness. They're not focusing on the method, because almost 99% of retail traders are doing are just looking at prices. So we're trying to focus on the technicals and trying to keep as sane as possible, even though it's very, very difficult certain days, and we all know that. So that's it. Now, let's take a look at the VIX. The VIX is a very reliable indicator. This is the longest VIX that I have, which is the weekly. Okay, and the weekly VIX has a major resistance at 45. If things go really wrong on the front end with elections and stuff, you can rest assured that we're going to hit 45 so fast your head's going to spin. It's going to happen like immediately. Okay, it's well past the Bollinger. I see that, but I also see a pattern, and that pattern is that this at least the first pattern completion is 45 on the VIX. The VIX closed at 38. So 7 points on the VIX is quite a bit. And here's the other thing that tells me that we are not out of the woods. Not that we're never. I always used to joke around and say, when people say, "Oh, we're out of the woods yet," I'm like, dude, we're always in the woods. We're options traders. We're stock traders. We're always in the woods. You just got to see the path in front of you or something. So if you look at this, and I mentioned this before, if you look at the slow stow pen, okay, it's not even. Oh, come on. I gotta get some sort of other program for when I'm annotating and highlighting the charts and stuff, because this takes too long. It keeps on doing stupid stuff. Okay, so basically, if you look at it, we haven't reached that overextended level yet. Short term, we have. On the fastos we have. That's why I'm saying we could have a quick, sharp rally, which they will sell. And that's what the markets have been doing almost every day. You get a sharp rally, then they sell. Then they bring it up from the bottom. There's only been a few days in the market where the market actually closed right at the bottom. And those are actually the best days to buy a few things. So it needs to get up here. By the time it gets into that 68.70 level, this is a very, very, very reliable contrarian tool. Okay. And this is for real swing traders. This particular time frame, weekly, because it spans many, many months, 2020 and going into 2017, going into 3 years. Once it gets to this level, that's when the market's basically, if the VIX gets to 40 in that 45 range, we're going to basically retest the 200-day moving average. That's how it works. In the meantime, this is what's looking. So if this suddenly abruptly turns around like this, like down, fantastic. I would love this candle to be green, and I'm going to go aggressively hard for 48 to 72 hours. But this won't happen immediately because this is a weekly chart. So let's take a look at the shorter time frame, such as the daily. So here is what the daily looks like. And I've been showing this repeatedly during the day. The daily is hitting the daily. There's your pivot, always the yellow dotted line. The daily also is showing a max move of 45. You can see that. However, the internals are quite overbought. And this one was actually, this one looks, if it starts to turn on the daily, then you will have a intraday rally, which could last about, at this point, time frames are very short, like maybe a day and a half. Because once the daily starts to turn around, this thing will have a very sharp pullback and try to head back towards the 30 range, 29 to 30 range, which will create a cup and handle. Everything kind of fits in. And if this is pushed down and this comes down here, I don't care what the candles look like. You can rest assured the minute it gets towards that 30 level RSI, and this, this is relative strength parameters, right? You can rest assured it's going to bounce. So that's what I'm saying, is that one must keep an eye on these things. And on the fast stochastics, obviously this one, can easily get oversold just by a 200-300 point move on the market during the day. Now, the one that I follow very closely also, and show you guys quite often is, and you can replicate these charts on your site, so you don't always have to rely on me. Let me see here, is the 1 hour, the hourly. So the hourly one is looking like this right now, very mixed, kind of like in the middle, like we're not sure, whatever. If somebody's bearish, they'll be like, hey, look at that, that's a bull flag. They'll say like that, the VIX, they'll go. Yep, with the lower Bollinger acting as support and the upper Bollinger acting as resistance. And they're not going to be wrong, they're right. And these daily chop. Pull back, markets shoot up a couple hundred points. Pull back, markets put up a couple hundred points. Pull up, markets fall a couple hundred points. So these do give me an idea on what it's trying to do, but I do keep an eye on the daily and the weekly because of what has occurred over the past 2 weeks. So let's get this out of the picture. Just wanted to pass that on to you guys. And we can let's dive directly into the New York Stock Exchange oscillator, the NYMO. Okay, that's out of the picture. Good. Clean this out. I had set the NYMO up for you guys before I started the session, so let me walk you guys through it. The NYMO is actually looking very constructive on the daily, just from a technical standpoint. There we go, sir. This is fantastic. It is starting to bottom. I like this. I'm a visual trader, so I'm looking at these things purely from a visual standpoint. I'm liking this. I am going to start to like this a lot more. if you squint your eye, you're going to actually see that these histograms are actually shrinking a little bit. So I'd like to see these MACD lines turn, but the markets move before the turn, just so you know. I like the fact that on Wednesday we hit 81.44. These are horrendously, oversold readings. And as you know, if I go back a little bit, let's say I go back on the daily, I go back to March, 6 months. Let's go back 1 year. There we go. Let's clean this out. Erase all drawings, get the pen back. Good. So you can see here, this was the COVID attack, right? COVID-19 breakdown. Horrendous numbers. There's a generational buying opportunity. You don't normally see 140 down on the McClellan. That's like, oh, holy cow, like forget about it. It's Armageddon. Generally, anytime you fall in the -70 range, and this is back tested for many, many years. I've been tracking them forever. -68, -79, -81, you get an immediate bounce. And that's exactly what happened on Thursday, which was sold. In the meantime, what was interesting was Friday, after the initial thump and damage and the markets, getting up, only being down 157, even those individual stocks didn't really recover that much at all, if you looked at it, because that was a lot of hedge fund forced margin sellouts, retail traders just panicking and selling. And remember that 60% of or more on a certain day in the market is dominated by, of course, algorithmic high frequency trading black box, computers, but also by ETFs, exchange traded funds, right? So when you have panic days like this and a panic week and 2 days, 3 days before the election, mom and pop's calling up the mutual fund company and said, listen, get me out of that, tech ETF or retail ETF, exchange traded fund, or whatever the case may be. Just park my money in money market accounts. So the funds have to do the selling either first, most of the time they do it later at 2:30 in the evening. 2:30 in the afternoon. What am I saying, in the evening? And it was interesting to see that they were the net buyers. And also, I think the hedge funds were the net buyers because of the short squeeze at the end of the day, latter part of the day. But generally, the volatility that you see in the latter part of the afternoon, between 2:30 and 3:30 p.m. is primarily because the exchange traded funds are dumping quite a bit to raise cash, because their customers want to shift into the money market account. They can't just take an exchange ETF and say, okay, it's in the money market fund. No, they have to sell it first and move the cash. And I'm sure you guys understand that simple logic. That's why you see this dynamic, billion to buy, 2 billion to sell at the end of the day, market on close, buy or sell orders, and those are primarily exchange traded funds which are doing the movements, chunky movements. So you get massive movements right towards the last hour of the day. So let's get back to this. So -81, boom, we closed at 58, which is pretty nice. But looking at the internals, like I showed you, it is they look like they're starting to bottom. Now, I would like to see this thing start to move towards the zero mark. Let's see what happens. But generally, the last time this happened in September, we were -79, we hit -81, and we had a very, very sharp rally. And remember, once this goes into the green, this gray part is actually green, dark green, and it starts to stall. You might want to do those preemptive moves, such as reduce positions and things like that. Now, this is not a trading tool, but this is a good indicator of the directional bias of the market. You cannot, if somebody's using the NIMO as a trading tool during the day, I don't know, maybe they can do it. I don't. I like to look at it at the end of the day. So as you can see here, this is starting to turn, and if it starts to turn like this, then that's going to help those MACDs and stochastics start to turn on the front end, as I showed you a few minutes ago, and things start to look pretty good. So this is actually constructive on a short-term basis. Let's take a look at the weekly, and that's going to give us a little bit of a picture of what this particular oscillator is thinking. The weekly is still pointing down. Just the way the VIX weekly is still pointing up, the NYMO is still pointing down. Now, anything can change. A couple of days of powerful bullish green candles, couple of 100 points up, recovery on the tech side, recovery on the material side. Remember, we have had 3 10-to-1 down days in a matter of 2 weeks. Yeah. Those are horrendously extreme oversold readings. 10-to-1 down days on the New York AD line, advanced decline line. I mean, that's like wild. It's like 200 down to 200 up, 200 issues up at 2,400, 2,000 down. Like, whoa, that's called whole-scale, massive capitulation, liquidation sales. 10-to-1 days when all 10 sectors are down. It's just like wild. And we have had quite a few of them. So you wonder, like, what's going on? So in a way, from a contrarian standpoint, it is certainly bullish, no question about it. But contrary or not, you still got to watch your pocket. So this MACD is still pointing down. This one is the worrisome part, the full stochastic, still pointing down. It either starts to stabilize and turn up, because if it gets down to 20, that's when we're going to hit that 200-day moving average and possibly slip a little bit lower. At that point, everyone's going to think like that's complete Armageddon, and it'll be a phenomenal tradable low. So that's why I'm saying patience is required. Keep cash on the side, trade intraday, take profits quickly as possible. And if you miss one or two, let's say an overnight gap open and stuff, fine. Otherwise, the market has a way of, especially for non-technical traders, what's the word I'm looking for? Death by 1,000 cuts. Exactly. So that's your NYMO. That's what it's looking like. And that's it. So let's take a look at some leading stocks. Paul, which one should I pull up?
I think Apple's a good one to look at. It's
Correct. It's
market leader.
Market leader, leading stock. Absolutely. Absolutely. Now, one thing before I go any further, the media makes a lot of spotlights, they missed this, they missed that. You know what? Overall, the numbers are pretty damn good. It had probably one of its best quarters ever. Now, obviously, they're straightforward, and Apple always likes to sandbag. You know what that means? They always like to talk less and deliver more. Now, they maybe sandbag, and they said because of the uncertainty, they can't give any real guidance going forward. Okay, well, the market doesn't want to hear that, but why should Apple lie? Okay. So from a technical standpoint, there's a gap fill here. These charts were drawn before. And that gap fill is 106. The numbers are there, 106.47, 107.83. It hit the upper end of the upper gap right there, 107.83. And then we have a definitive bottom, in my opinion, which would be, like that, if you want to look at it as a neckline of a double top or bearish head and shoulder pattern. 1 second. Choose pen color. Really got to get another app in here for my drawings. Okay. So Apple never quite made it there. It hit that mid channel pretty much and then pulled back. Pretty substantial pullback. Kissing the gap. Best buying, in my opinion, from a technical standpoint, the biggest reward to risk ratio, if you want to look at it that way, is 103. That's 5 points. It can happen in 3 hours. You know that. Something happens on Tuesday, things are delayed, contested, blah, blah, blah. We won't find out till 10 days later. Apple will be down 6 points in 2 minutes. So that 103 level is key. A break below that would bring us into the 100 level. I'm just showing you the downside stuff first, which would be a gap fill, a major gap fill. It would be between 96 and 100. And there would be major buyers there. And that would be kissing the 150-day moving average. So, like I said, don't go hog wild because it's just up a little bit. If you want to trade it, I'm going to trade it. I'll take monies real fast, but I'm not going to put a lot in there and say, oh, yeah, it's definitely going up this time. It will go up. Apple is a, it's what's the word I'm looking for? I mean, Apple's got its dividend moat around it. It's fantastic. It's a value stock if you really think about it. That's why value income fund managers, believe it or not, buy a lot of Apple because they get such a fat dividend on a high growth company. So anyway, so that's the way I'm looking at these levels: 107.83, where it bounced off from, 106.47, 103.14, and with the movements, I repeat again, the very, very active, heavy volatile movements in the market. Apple being down $3, $4, $5 means nothing. It can turn around $3, $4, $5, $6, $7, $8. But these are the critical levels that you hear about sometimes, that 96, 97, 100 levels. And if things get really messy, it will go there. I'm just letting you guys know. Upside is the upside. Upside, we know. The 50-day moving average, 117. Getting back into the channel is around 114. These are the uptrend channels where it broke on Thursday. That's when it was rallying really hard. And then of course you got that 120 round number to contend with. And if it breaks above the 50-day, at one point or another, after slipping and sliding, Apple is going to, just like the market, going to mean reversion play to the 50-day moving average. Excuse me. All this technical talk, my throat got dry. So that's the simplest way of looking at it. Let's take a look at the internals on Apple. Looks just like the market, baby. Look at that, right there. It was starting to climb up till the 29th, then boom, got slapped down. This is still quite oversold, sitting around there, minus 176. These are pretty extreme oversold numbers, by the way. This one looking the same way. It needs to stabilize and start to turn. If it starts to have a waterfall decline, then we're going to look at those numbers that we're looking at. Let's take a look at.
Hey, Frank, before you move off Apple, can I ask you one quick question?
Sure.
The weekly Apple chart, the MACD is historically all-time high and crossing down. Is how big of a concern is that?
It's concerning. From a technical standpoint, it's concerning. And that concern is how big a concern? The concerns are the numbers on the concern, as in how low can they go down? Like I said, max case scenario, 97 to 100. Keep in mind that if you look at the weekly, just one thing, it's a good thing you pointed out. All we're doing right now is we're retesting this blue line here, which is the 20-week moving average. Okay. Yep. The distance that Apple traveled, and some people say, oh, it's so overvalued and this and that. Well, they can make a case. They can make that case by looking at this, because look at normally how Apple travels above the distance Apple travels over the 34, the 50-day moving average. That standard deviation when Apple hit 138 was a lot. That's almost +8. It was meant to mean revert. So it did that, held its ground. And so now it's coming back into that zone where it's reasonable, It's not too far away from the highways. It's like, okay, will it have to come down and retest 93? No, it doesn't have to. Of course not. If things stabilize overall, Apple iPhone 12 sales are going to go through the roof. China, they're already buying it like crazy, and so all that is good. Now let's take a look at the internals. Internals, well, obviously a lot of selling. Forget that. This is, this weekly, very seldom. This is actually positive. What I'm going to say, very seldom gets that oversold. When weekly Apple gets oversold, okay, like it did in March. And let's say, we get a chance to buy this stock around this level here between, let's say, 197 to, on a certain day, to 103. This weekly, this oversold, and I know it's pointing down. I understand that. Okay, big deal. They trigger multi-week rallies, and you know what they'll do for the market. They trigger multi-week rallies. Look at that. This was 2019. Weekly got this oversold. This was this recent March, the COVID crash, right? Multi-week, yearly rally. Every single week, it's a green candle. December 2018, the Christmas Eve massacre, right? Multi-week rally. So we're getting there. Give or take a few points. It could trigger a multi-week rally, which will obviously spill over into the market. Apple being a a component of the Dow as well as the Nasdaq 100, and the tech overall tech industry. It'll be sweet. So we could get another one of these generational buying opportunity, but before that, maybe we'd like to get it a little bit cheaper instead of rushing into it too fast, too quick. Does that answer the question?
That's great.
Yeah, I'm excited. I'm excited to see this because very seldom, as you can see, going back to 2017, 2018, does Apple get this oversold? On what? Their growth just suddenly came to a screeching halt? Right. You know? And from a technical standpoint, this can be construed from a much longer time frame. And again, all the numbers match, okay, based on what I just explained, what the downside can be, as nothing but a massive multi-month bull flag consolidation channel. You can see that yourself. Let's clean this out. There. And if it holds this, the 103 level, then expect a pretty sharp bounce. But this is getting exciting. Apple, from a technical standpoint, is getting pretty goddamn cheap, guys. And I like that. Let's take a look at another major tech player, Netflix. Netflix has the same story, except Netflix has something interesting. Netflix is, with all this COVID start going on, Netflix is used as a COVID play, right? Exactly. So this one is a very tradable stock, ladies and gentlemen, for traders. It spikes hard. You got to be quick on the sell. Throw out some sells out there. Maybe the system will just take it, but I try to do it manually. So you'll notice that this one on a 1 hour basis is at this point is screaming buy. Now, screaming buy or not, I know that's kind of a cliche. You'll notice that Netflix on certain days will be up 3, 4, 5, 6, 7, 8, 9, 10 points while the market is dead blood red. You guys have noticed that, right? But it seems to be trading on a slightly different dynamic. A different set of algos seem to be trading Netflix, by the way. The same thing happens with Roku at times. So that's something from a trading standpoint, it's a great trading stock. It won't trade in tandem. The same algos are not going to be buying and selling Apple and Netflix together. So please keep that in mind, because after all, we're traders and we'd like to take advantage of these type of moves. The 15-minute chart, it's a great trading chart. Look at that. Look at these spikes. Forget the internals. Look at this. Some analysts will come out and give it a 700 thing, blah, blah, blah. Netflix just raised prices too. They just raised prices, not on their basic service, on the other services. And on the 4K and all that services. That's great. There's more money coming in their pocket. Look at that. You buy the 480, bang, 514. You're talking intraday and overnight. That's 33 points. You bought it, let's say you bought it at the close at 500. Next day, 505. Not worth trading for 5 points, that's for sure. But each of these points are good for 10, 15. You can see that. Look at that. 480, 490. You can trade this stock for 10, 15 points quite often. It's a great trading stock. So on that note, listen, there's a lot of stuff to talk about, obviously, but you know, that's the way it is. One last one, another major move, major technical stalwart, tech stalwart is Facebook. So let's take a look at that. Very important to keep that in mind. So Facebook, the same story. It's a very tradable stock. Just 1 second. Just like Netflix. Look at that. You could trade this baby 268, 283, 10, 15, 20 points. You can put a lot of money in your pocket. You got to be quick, though. You got to be quick. Yes, go ahead.
Frank, what are the top 3 stocks if Biden wins versus if Trump wins?
That's a good question. I mean,
Got to think.
you tell
Like
me. Tell me. I'm listening.
if Trump wins, I'm thinking like Lockheed Martin, Boeing, maybe.
Boeing. Yes. You know, those guys.
For Biden, Tesla.
Tesla for sure, because he's such a green energy guy. If Trump wins, the market's just going to rally 1,000 points, I think. That's my opinion. Seriously. It'll be just like, okay, we're going to deal with another couple of crazy tweets and stuff. At least we know what we're dealing with. Trump is a known commodity, right? We've already dealt with him for 4 years. So the fact is that even though sometimes he can be as annoying as a pain in the butt, overall American business still likes him. And so the fact is that he might be a little bit more moderate. My feeling is that Trump wins, he establishes his, consolidates his new cabinet, this and that. I think he cuts a deal with China. He shows like, okay, I punished them. Now I'm, okay with them. You know how he goes. So, once he, what's the word I'm looking for? He takes his political capital and says, okay, I'll work something out with you guys. Markets will go hog wild. Now, if he does the other things, such as go after hard over the Facebooks and the Googles and Twitters and stuff like that, the market might not like that short term. So if Biden wins, it's tricky for me to tell. Yeah, clean energy is definitely going to go. Text, like you have said yourself, Paul, might benefit because he's going to be a little bit more, he's still a China hawk, but he's probably not going to be in the face of the Chinese as much as Trump is. So I think it'll be very beneficial for tech. They've been putting a lot of money into his campaign. I think healthcare will rally because he's a little bit more moderate than just going hog wild on certain things. Not that Trump is, he's actually helped the healthcare company. But yeah, I think healthcare is going to be good. I think I personally think these social media companies like the pins, the Facebooks, and the Pinterest and Snap, these guys are going to keep on growing. They're going to keep on growing.
I guess one thing also, Frank, is we don't have to solve this right away. I guess we just need to be aware that there are going to be some sectors that take off no matter who wins or what the result is. So get on that train early.
Yeah, exactly. Absolutely. I'm totally, with you on that. Look at Mohawk
Frank.
Industries. The stock was up like huge. I'm looking at it like what? Yes, go ahead, Chris, and then we're going to wrap up. Go ahead.
The only defense stock that I could see that was green on my watch list was Huntington Ingalls.
I don't even know the company. What's the symbol?
It's Huntington Ingalls Industries, HII.
Okay, don't know about them, but
they're
certainly.
shipbuilder. They basically do what General Dynamics does. That thing just defied gravity on Friday. Everything was deep red, and that thing just rocketed up. On no news, I couldn't figure out why. They got earnings coming up, I think, next week or the week after.
Okay, writing this. I'm going to keep an eye on this one because it's coming off a very low base, which excites me. You know what I'm saying? Look at that.
Yeah.
It's coming off very low base. No, I'm listening, Chris. Go ahead. This is how I learn.
They've all taken a beating. Lockheed Martin, Boeing, General Dynamics is multiple downgrades. They've all taken a beating, except for Huntington Ingalls. Go ahead.
No, but there's a difference though. This is Lockheed Martin, okay? Boeing, we already know Boeing's short. This is what it looks like. But you look at that HII, the one you just brought to our attention, and thank you. This is like, whoa, man. I know what my floor is. Worst case scenario, I got a 11-point down move on a $147 stock. I actually like this, so I'm definitely going to chart it. I'm going to put it out there. I'm going to buy some. I'm going to buy some long dated calls because it's got so much upside it can move from that it's not even funny. You know what I'm saying? That's I appreciate you bringing this, yeah, because those other ones, yeah, they've kind of lopsided, but they're still like not coming. They're going this way and being kind of slowly like that. This one's just like 280, 280, and then 137. To me, a stock moving from 137 to 147 is nothing. This thing can move up to 180 bucks. I'm going to do some homework on this too. So I appreciate you bringing this to our attention. These are the type of things I like because I know what my definitive downside is. You know what I'm saying? So when I know my downside, I get more aggressive on buying that thing. So makes sense. Now, the other stocks that will benefit because whoever wins, let's not forget, ladies and gentlemen, the stimulus bill, they're going to do it. Okay? The Dems are going to do a bigger one where there's to show that we can do a bigger stimulus bill, even though I think Nancy Pelosi has been a royal idiot for not agreeing to a piecemeal stimulus bill. But that's for political reasons, but which could have really helped the markets and helped a lot of ordinary Americans, everybody. So anyway, our things like this. Look at this chart, United Rentals. This is a beauty. This stock will go past 200 just like boom, just like that. Let me let my dogs in. Hold on. Sorry about that. I think the wind picked up on the patio a bit, so the little one started jumping to come in. All right, so yeah, United Rentals. So are you still with us, Paul?
Yes.
Okay, this one definitely keep in your radar. I can't track all of them. I think the stimulus will get passed. You know that. Whether the Republicans win, whether the Democrats win, they're going to pass the stimulus bill right away. So that's going to be great for infrastructure. Caterpillar, no question about it. Okay. Vulcan Materials. Look at these charts. These charts are not even broken. I mean, they're the most beautiful charts. I mean, like, this is great. So we need to start focusing on these things regardless of anything, because they seem to weather the storm in the market far better than others. Boeing's going to be flying very soon, so Boeing is always screaming buy. The only problem is that when you look at the daily chart, it's really not giving you that much. You got to really zoom in a little bit. There. So we got 170 on the top. We got 140. I mean, Boeing right now, personally, I think is a screaming buy because at 140, you got a 30-point trading range here, because it normally moves in 10, 15-point increments. And once they get the full-scale clearance to fly, then you start looking at the daily charts. And then, of course, this chart is nothing. It's my other Boeing chart that I show you guys, which I'll, again, put it up tomorrow, is the one that you need to be, the flight map, I call it. This one's really not telling us anything. What's the other one? This one came to my attention. Mohawk Industries, MHK. Great earnings. They make what? They make sheetrock and stuff, right? Housing industry strong. Look at that. Off earnings. Bang. Didn't even like buy it. Like, what an idiot I am. I mean, there's some stocks which I just slap myself. I'm like, why the hell didn't I, get in there? What was the other one that was up like a gazillion points? Oh, for solar. I was going to buy a few calls. I was going to put it up as an ER thing. For solar went like crazy. Stock went from 81 to 98. Do you know what options would have done? Who the hell would care about the market and SPY puts? We'd be just like, bang, like the snap type of move, the pins type of move, the PINS, Pinterest. So these things, yeah, we have to start looking a little bit away from the same things we look at. But again, we're not mutual funds, so we don't have the capability of buying like a zillion things at one time. But there's a lot of different things which are, which are going to be very interesting going forward, based on the elections. Guys, fantastic. Thank you for all three being here. You guys definitely, give me a lot of juice to go out there and do the right thing. It's great, and let's make this week happen in a big way. Let's pray that the elections and everything goes well. It is America after all, and somebody's got to be president, right? Just make it smooth, and let's just start going back to the world of business and getting back in the business of doing what we need to do. On that note, see you guys tomorrow. Thank you. Good night.
Thanks, Frank.
Thank you, Chris. Thank you, Mike.
Thanks, Frank.